Welcome, and thank you for joining Bartlett's mid-year strategy update. I'm Holly Mazzocca, president of Bartlett Wealth Management, and it's my privilege to introduce all of you here today to our presentation to share a few quick updates on our Bartlett team before I hand it over to Brian Antenucci to lead us through today's conversation. We've shifted from our annual strategy update sessions to these more frequent webinars to ensure that we're providing real-time updates to all of you amid rapidly changing markets. Whether you're tuning in from across the country or around the world, we are excited to connect with you here today. For those of you who enjoy our in-person events, know that these will continue with a focus on more social gatherings. Keep an eye on your inbox for invitations coming up in the fall. Since our last update, there's been a lot happening here at Bartlett. Staying true to one of our Bartlett Way core values, growing is thriving, we've had a strong start to the year, welcoming new clients and adding 8 additional team members across our 3 offices, supporting client advisory, research, and client service capabilities. In addition, we've recently renovated our Chicago office. Our Louisville team is planning for an office expansion, and our Cincinnati team was recognized by the Cincinnati Enquirer top workplaces. Our team is energized and dedicated to delivering the very best Bartlett experience to each of you. Now, I'm pleased to introduce Brian Antenucci, Principal Wealth Advisor and Director of Investment Solutions, who will share an update on the markets and our overall outlook. After Brian's comments, he'll be joined by Matt Stith, Director of Equity Research, to discuss trends in artificial intelligence, John Finkler, Head of Fixed Income Services, with an update on the bond market, and Jason Katz, Principal Wealth Advisor and Head of Financial Planning Strategy, to share the latest legislative and tax updates. We'll be saving plenty of time for questions at the end of today's presentation. We encourage you to use the Q&A box at the bottom of the webinar screen to submit your questions as we go through the conversation today. We received a number of great questions in advance during the registration process, ranging from what are the most significant changes in our strategy since December to very specific questions around tax and legislative changes coming out of the One Big Beautiful Bill. So with that, I'll turn it over to Brian and the team to get us started.
Well, thank you, Holly. As mentioned, it's been an eventful first half of the year. We'll have no shortage of topics to cover today. So our goal today is to cut through the noise and tell you a little bit about the most significant factors impacting the markets, your portfolios, and your financial plans. I'm excited to turn it over to our panelists to share details on these topics. But before doing so, let's discuss some important numbers for the first half of 2025 with a few key charts. This first chart may not be one you've traditionally walked through with your Bartlett advisor, but it's an important one for global markets. This US dollar index measures the performance of the dollar, highlighting its strength and weakness relative to a basket of 6 major foreign currencies over the last 12 months. The most heavily weighted of these is the euro. Essentially, this shows how many dollars you can get in exchange for another currency. You'll notice that 2024 was a great year for the dollar, reaching levels not seen since the early 2000s. So there are a number of reasons for the strength in 2024, most notably the combination of a strong US economy, an interest rate environment in the US relative to the rest of the world. The strong demand for the dollar saw an increase in value. 2025 has seen this trend correct significantly as we've engaged in trade wars with a slower growing economy, increasing fiscal deficits, and interest rate cuts on the horizon. With that in mind, let's take a look at performance of US and international equities in 2024, shown by the green bars, and so far in 2025, shown by the navy bars. You'll notice there's been a bit of a reversal of roles for the two markets. US equities outperform international by over 17% in 2024. This year, while US equities have had a strong bounce back from earlier weakness, international is still leading by over 12%. This speaks to the value of maintaining a diversified portfolio. It's indicative of how quickly conditions can shift. Speaking of the value of diversification, you'll notice the steady return to the bond market throughout. John Finkler will elaborate on our views on fixed income shortly, but know that while we've seen some significant swings in the equity markets, bonds have continued to turn out healthy yields and returns while protecting principal for investors. Now, tying these first two charts together, let's go back to the US dollar and the implications for your portfolio. The performance of the dollar relative to international currencies can play a significant role in the performance of international stocks. I like this table because it lifts the veil on what's really causing the outperformance of international stocks. Starting at the top, it's not due to the increased profitability of international companies, since you can see an actual negative earnings growth. Dividends played a negligible role. International outperformed just slightly. Now on valuations, international has got a bit more expensive thus far, shown by the increase in valuations. But the biggest factor is the currency impact. To put it simply, the declining US dollar has acted as a major tailwind for international markets. That is to say, when the price of an international stock is translated into US dollars, you're getting more bang for your buck. It's the same rationale when the president mentions wanting to see a weaker US dollar to bolster demand for US goods. A weaker dollar is better for the international buyer. The same can be said for US investors owning international stocks. Well, it's tough to predict where the US dollar will go from here. As mentioned, there's factors such as interest rate differentials and the strength of the US economy relative to others plays a significant role. So that's where we look at additional metrics when determining the health of markets and positioning client portfolios for the long run. This chart compares some of the underlying fundamentals for each market. The US market in 2025 is dominated by tech stocks specifically, with a few other industries such as financials and healthcare playing critical roles. International, with a focus on Europe, is dominated by more traditional sectors, industrial, energy, and big pharma, healthcare. And these offer healthy dividends, but rarely see the same growth trajectory that we've seen in the US tech in recent years. You'll notice the earnings growth, unsurprisingly, has favored the US. Additionally, the forward price to earnings ratio, a measure of how expensive a market is, reflects the premium that comes with greater exposure to sectors that have seen or expected to see stronger earnings growth. I point all this out because many investors often look for one metric to simplify their investment decisions. Are international stocks cheaper relative to US stocks? Yes, when looking at price to earnings. And that's also been the case for the past 15 years. But are international stocks on the same growth trajectory? No. And these are critical questions to ask when making investment decisions. Looking for a reason why the US can outperform long term, look no further than the earnings growth of the US market relative to international. 8.3% annual growth rate versus 3.7% over the past 5 years. This trend has continued thus far in 2025 and continues to garner our attention. And that's why our in-house team of analysts and your Bartlett team work to find the right balance for your individual goals. In that same vein, let's take a look at one more chart on US equities to talk about why the market is hitting all-time highs. And the short answer is earnings growth. The green bar shows first quarter of estimated earnings growth at the beginning of the year versus where they ended up. You can see the significant outperformance of expectations, and this is driven heavily by continued strength of tech stocks and the rapid development of AI. Matt Stith will expound on the current state of artificial intelligence and what we're paying attention to going forward. But this chart shows the ongoing strength of US equities. This is not simply animal spirits run amok. Earnings growth is the fundamental data we look to support the rationale to continue to own US stocks. And the main reason stocks are hitting all-time highs. So let's sum it up. The U.S. consumer is showing strong earnings growth and healthy profit margins. Additionally, the consumer, which makes up 2/3 of the U.S. economy, is continuing to show strength. We see it in spending, low unemployment rate, and inflation that's still not low, but moderating. Finally, the continued investments in AI still appear to be in the early innings. That's not to say we're blind to areas of concern. As Jim Haggerty says, we don't look at the markets through rose-colored glasses. Valuations are high relative to historical averages, and we're watching for any slowdown in growth that would impact these valuations. John Finkler will expand on our concerns regarding the fiscal and monetary policy and the uncertainties that exist. Although these concerns have moderated to where we were just a few months ago, but he'll expand upon that. And lastly, at a certain point, investors need to see return on the AI spending cycle. And with that, I think it's a good time to turn things over to Matt, provide additional insight on some of the things we're keeping a close eye on as it relates to AI. So Matt, where are we in this cycle, and are we seeing any scenarios where companies are really getting a return on these significant CapEx investments in AI?
Yeah, great, Brian. Appreciate it. So yeah, we've talked about artificial intelligence at each of our last two strategy update sessions. And our message has been that we viewed AI as a long-tailed investment theme and that it was important to have adequate exposure to it in client portfolios. As we speak to you today, we remain bullish on AI as the investment theme is strong and, in our opinion, has been the best underlying fundamental growth story in the market year to date, and a significant driver in the market's recovery over the past several months. Supporting this is the strength in recent corporate earnings reports for companies most exposed to this theme, such as NVIDIA, Broadcom, and Oracle, to name a few. While it's always difficult to predict where we are in any technology innovation cycle, we feel that we are still in the early stages of what looks to be a long cycle. As you can see in this chart, technology cycles historically have been measured in decades, not years. Focus over the last several years has largely been on the AI infrastructure build-out and AI development, including things like data center construction, networking, procuring the most advanced processing chips, and securing power to make it all run. Some of the biggest beneficiaries and best investment opportunities have been companies that provide this infrastructure. Again, NVIDIA is an example, Alphabet, Arista Networks, Constellation Energy Group. All of these companies are deeply involved in the infrastructure that's needed to support AI. While we expect the infrastructure companies to continue to benefit and to be important participants in AI development and growth going forward, as can be seen on this chart you're looking at, we are seeing a growing investor interest in how AI will be used to create business value and drive new revenue streams. I talked a bit about this a couple years ago during our strategy update session, but at that time it was more conceptual than tangible. But today it's becoming a reality. AI investment continues to outpace AI benefits, but that gap will narrow over time. And as an investor, we are looking for these second derivative beneficiaries and investment opportunities. We are seeing the AI investment cycle transition from initial experimentation and infrastructure building to actual use cases. The focus now is on deploying AI solutions to solve real-world problems, drive business value, and demonstrate profitability. While not as easy to quantify as AI spending on something like NVIDIA GPUs or Dell servers, we are seeing and hearing from companies that the use of AI is creating efficiencies, driving cost saves, and generating new revenue streams. For example, in a recent interview, Salesforce CEO Mark Benioff said artificial intelligence is accounting for 30 to 50% of company workloads. A second example is Accenture. Accenture, which is a large global consulting company, reported quarterly financial results just a few weeks ago. Their Gen AI bookings were $1.5 billion in the quarter. This was up from $900 million a year ago and basically zero 2 years ago. One of the best examples of how a company benefits across the AI spectrum is Microsoft. Most of us are familiar with Microsoft being an early AI beneficiary, an early infrastructure beneficiary, similar to Alphabet and Amazon. But they are seeing significant benefits beyond this. For example, Microsoft grew its cloud service revenues 33% in its most recent quarter. Of this, 16 points of growth came from AI services. Sales in Microsoft's AI-powered Copilot are tracking at a $3 billion annual run rate. Microsoft's CEO recently stated that 30% of all their coding is being written by AI, allowing them to allocate employees elsewhere in the company and do more with less. Management has also talked about how internal AI-powered solutions have demonstrated significant time savings and operational efficiencies. To conclude, we remain bullish on the AI investment theme, feel that client portfolios should have adequate exposure to this, and we continue to actively research future AI beneficiaries and investment opportunities.
Thanks, Matt. These are exciting developments. We appreciate the additional insight on which companies are capitalizing on different areas of AI spending. Well, let's shift gears and check on the current state of the fixed income and interest rate environment with John Finkler. John, what's changed since you gave the November strategy update on fixed income, and what's the team focused on going forward?
Yeah, thanks, Brian. Well, the fixed income market has faced a fair amount of volatility recently, driven by a long list of factors, from unpredictable policy decisions to tariff uncertainty, to ongoing geopolitical tensions and the Moody's downgrade of U.S. debt. And while some of these pressures have begun to ease, trade negotiations remain front and center, and increasingly, attention is shifting to the Federal Reserve and interest rate policy. Now, this backdrop has pushed short-term yields lower over the past quarter as markets increasingly expect the Federal Reserve to begin lowering its policy rate. Now, at the same time, longer-term yields moved higher due to concerns about future inflation and the growing U.S. debt and deficit. And we'll touch more on the debt picture here in a second. Now, on the screen, we're showing the U.S. Treasury yield curve at 2 points in time. The green line is as of March 31st, and the blue line is as of June 30th, to really highlight how these dynamics have played out. Now, as a quick refresher for those less familiar, the yield curve shows the interest rates or yields the U.S. government pays to borrow money across different time horizons, from a few months to 30 years. Typically, longer-term bonds carry higher yields than shorter-term ones, reflecting the added risk of lending money over a longer period. So let's consider what's shaping the Fed's thinking around when to start cutting rates, mainly their focus on jobs and inflation. The unemployment rate sits at 4.1%, which on its own does not signal imminent recession. But under the surface, there are signs of softening in the labor market. Now, for the Fed to act aggressively from here, we'd likely need to see more definitive signs of labor market weakness through spillover to the headline unemployment rate. Now, on inflation, the picture is still evolving. The Fed is taking a wait-and-see approach when it comes to whether tariffs will meaningfully push prices higher. Thus far, CPI data suggests tariffs haven't moved inflation significantly, which is encouraging, but that does not rule out future pressure. So the Fed is really balancing the data in hand with future uncertainty. And when this happens, the best thing to do is to be patient with adjusting policy until the unknown becomes known. So given the current dynamics, we're being very selective about where we add interest rate exposure, and we're mindful of stretched valuations in parts of the market. Now, in this environment, we believe active management is key, as passive strategies may leave portfolios overexposed to duration or credit risks without sufficient compensation. Now, I mentioned longer-term yields being concerned with potential inflation and the U.S. debt and deficit. With the latest budget and tax package from the administration, renewed attention has been placed on the size and trajectory of the U.S. debt and deficit. Now, as a fixed income investor, a rising deficit means the government needs to borrow more money, which it does by issuing Treasury securities. Now, when Treasury supply outpaces demand, the government may need to offer higher interest rates to attract buyers. And that's the dynamic we're seeing in the Treasury market, with longer-term yields moving higher, even as the Fed signals its intent to move short rates lower soon. Right now, the U.S. carries about $36 trillion in total debt, and the annual interest expense is approaching $800 billion. And while the White House claims the bill will reduce the deficit through increased growth and spending cuts, the Congressional Budget Office estimates the bill will add about $3 trillion to the deficit over the next decade. Now, as you can see on this graph, that would bring the deficit as a percentage of GDP to about 7%. There are still many unknowns as well. Specifically, if these tariffs remain in place, the revenues produced could help offset some of the costs of the bill. We've already seen a substantial rise in tariff revenues in recent months, an increase of over 100% year to date compared to the same period in 2024. But the new spending package as we know it has the potential to magnify already elevated borrowing needs and pressure the Treasury market, contributing to higher yields. Now, these higher yields in turn will keep the interest costs elevated, straining the federal budget and limiting future policy flexibility. It's a vicious cycle that we discussed during last fall's strategy update. And the recent downgrade of U.S. debt from Moody's, the last of the three major rating agencies to downgrade below AAA, reinforces this long-term risks. This is following years of unchecked spending, money printing, even outside of crisis periods. Now, while government support was vital during the Great Recession and COVID, these ongoing deficits are becoming harder to justify. So this is a dynamic we continue to watch, particularly as it relates to fixed income strategy. The high debt levels and potentially increasing deficit could push long-term interest rates higher, so we're favoring the short to intermediate end of the curve while keeping our overall duration closely aligned with our benchmarks. Now, even though yields have eased from their recent highs, we continue to see a strong case for fixed income in portfolios. Bonds not only offer a reliable source of income, but they also serve as a stabilizing force in portfolios, especially during periods of equity market volatility. Now, on the screen, we've graphed yields across several key fixed income sectors relative to their 10-year medians and historical ranges, focusing on the 1 to 10-year maturity spectrum. Now, this is by no means an exhaustive look at the bond market, but it does reflect the sectors we focus on most in our strategies. Now, what stands out is that today's yield environment offers a favorable entry point across many of these areas. Core sectors like treasuries, investment-grade corporates, municipals, and agency mortgages are offering yields not seen in over a decade, presenting attractive opportunities without taking on excess risk. Now, high yield still offers elevated income, but with greater credit and market volatility. So all in all, Brian, we think today's yield landscape presents a nice opportunity for income-oriented investors to lock in attractive yields across a range of high-quality sectors.
Thank you, John. I know our clients appreciate the extra yield they're receiving on their fixed income portfolios compared to the low interest rate levels we were stuck in after the financial crisis. Well, let's switch gears a bit and talk about taxes. The president just signed a new tax bill. It's almost 900 pages and over 100 new provisions. Jason, I know it's hard to contain your excitement about all these tax changes and provisions, but can you give us an overview of some of the key provisions that may affect our clients and their businesses?
Yeah, thanks, Brian. So last November, I spoke to you all about the possibility of the sunset of the Tax Cuts and Jobs Act that was passed back in 2017. And my message to you was to be mindful of the key provisions that could change, but to expect a tax bill to be passed given the alignment in the houses of Congress. Well, on July 4th, the president signed the One Big Beautiful Bill Act into law. And as Brian mentioned, there are way too many provisions to walk through, but my goal is to discuss a few that may impact you or your business. Let me start by reviewing 4 key items that affect individual taxpayers. The first provision I'll highlight is the extension of the individual tax rates under the Tax Cuts and Jobs Act. These rates were actually set to rise for most taxpayers, with the highest rate reaching 39.6%. However, this bill keeps all of the rates the same as they are today, with the highest marginal rate being 37%. It also makes the rates permanent, which will make future tax planning a bit easier and locks in these historically low tax rates for the foreseeable future. The next item I'll talk about is the state and local tax deduction, or the SALT deduction. This provision received a lot of press, but at the end of the day, they agreed to increase the deduction to $40,000. The previous deduction was limited to $10,000, so this will benefit most taxpayers who itemize their deductions, especially those in higher income tax states like our friends in Illinois. This deduction does phase out at $500,000 of income and is scheduled to revert back to $10,000 in the year 2030. Now, this provision is effective this year, 2025. So there may be an opportunity to accelerate some income or property tax payments into 2025 if your total amounts that you've paid during the year are below $40,000. So be thinking of maybe those property tax bills that are due early next year, or maybe a fourth quarter estimated tax payment. Possibly accelerating those into 2025 might make sense. The bill also made a change to the lifetime estate and gift exemption. As a reminder, this is the amount that you can give during your lifetime or at your death without paying any tax out of pocket. This year, the exemption is $13.99 million per person, and that was actually set to be cut in half to about $7 million without intervention. The new tax law makes the exemption $15 million per person. It also indexes it for inflation, meaning it'll go up each year, and it makes it permanent. So this higher exemption level will continue to shift our focus away from exemption planning and more towards income tax planning, specifically taking advantage of steps up in basis at death and asset protection planning. And one final provision that I'll highlight for individuals is the new $6,000 deduction for people over age 65. Now, this provision is the one that had the ultimate goal of no tax on Social Security. But to be clear, it does not eliminate taxes on Social Security, but it does provide a deduction for those over age 65, many of which are receiving Social Security, as long as they are under the income limits. Now, this deduction is fully available for single taxpayers who have income less than $75,000 or married taxpayers who have income less than $150,000. This deduction phases out completely, however, at income levels of $175,000 for single and $250,000 for a married couple. This deduction is in addition to the larger standard deductions already available to those over age 65, and it doesn't require that you itemize your deductions. Now, on the other hand, unfortunately, this provision is only available for 2025 through 2028. Now, there are several other individual tax provisions in this bill, including an increased standard deduction, increased child tax credit. There's a new deduction for tips and overtime income. There's a new deduction for interest paid to purchase a US-made car. And there's also a rollback of many of the clean energy credits that we've enjoyed over the last several years. So on that last point, if you are in the market for a new electric vehicle, you may want to consider purchasing that vehicle before September 30th of this year when the credit does expire. Now, there also are a lot of tax changes that affect small businesses. These include 100% bonus depreciation on qualifying assets, an expanded Section 179 expensing, expanded expensing for research and development costs, and the qualified business income deduction was made permanent at 20%. Now, it's this last provision that was a major concern of ours and many tax planners for those who own pass-through entities like LLCs, partnerships, S corporations. But the new tax law addressed those concerns when they made this deduction permanent. So there are a lot of new provisions for businesses, and many of these provisions are benefiting U.S. manufacturing companies. So if we take a step back, overall, the new bill keeps income taxes at historically low levels. Although they do eliminate some clean energy tax breaks as well. There are increases in the bill on defense, and they've narrowed the scope of Medicaid and some SNAP benefit programs through work requirements. And as we heard from John previously, the bill is estimated to increase the federal deficit by $3.3 trillion over the next 10 years. Now, I caution you against making a conclusion about your overall tax situation based on just one or two of these new tax provisions, because there's a lot of interplay between these provisions, the current ones that are in place, and all of the different income phase outs. So therefore, I encourage you to reach out to your Bartlett advisor with questions and know that they are ready to use our tax projection software to analyze how the new bill affects your particular tax situation.
Well, thank you, Jason. It's obvious our financial planning team will be busy helping clients navigate this new tax environment. And that was an excellent summary. So before we get to the Q&A portion, let me give a quick summary on some of the big takeaways discussed today. The first half of the year saw a strong outperformance in international stocks, flipping the script from 2024 when U.S. markets dominated. A significant contributor to international returns was the declining U.S. dollar. While U.S. valuations remain elevated, strong earnings growth, supported by artificial intelligence developments, continue to provide momentum and rationale for maintaining exposure. Within fixed income, we see opportunity for strong returns based on historically attractive yields, providing downside protection for investors as well. We pay close attention to monetary policy decisions and ongoing debt and deficit concerns that could prove detrimental to bond markets and investors if not properly addressed. We'll continue to work with clients regarding impacts to individuals and businesses from the passage of the new tax bill. This presentation thus far has sparked some great questions from the audience, and we want to devote the remainder of our time to answering as many as possible. One of the questions focuses on tariffs. So I will send this over to John and Matt. If you can talk about how are the upcoming tariffs going to affect my investments. So, John, why don't you start from the bond side and Matt from the equity side?
Yeah, sure, Brian. Clearly a hot topic right now, and one we're really focused on, and really, as we think about what we're doing in strategies, and we're really focused on kind of where and when we're going to see these tariffs kind of play through to the overall inflation rate, because ultimately that's what the Federal Reserve is focused on, is maintaining those stable prices. If we think back just a few months ago, I mean, it's funny because it wasn't long ago that economists were expecting tariffs to cause a 3.5% to 4% increase in inflation. Consumers were even worse. They were expecting inflation to be 6% plus, and we've really come off of those peaks. We just had a CPI inflation print yesterday. It showed year-over-year rate at 2.7%. So there has been evidence, I think, of these tariff-related price increase, specifically as you look at some of the individual goods. But I think it's still hard to argue that there's really an alarming increase in our overall price levels, or really evidence that can be sustained for a long period of time. So we're really focused on what kind of playthrough we see from the overall tariffs to the inflation rate to really figure out what the Fed might be doing. And they've informed us. They've told the market that they're going to be very patient and allow for those price increases to play through if they actually do. So really focused on what the Fed is doing here, and again, kind of maintaining full duration in our portfolios, but favoring kind of that short to intermediate part of the curve because of some of those other concerns I talked about with the overall debt and deficit picture.
Thanks, John.
Yeah, Brian, from the equity side of things, it is tough to incorporate, what type of potential tariff impact could ultimately impact some of our companies. We just don't know. And the tariff situation is very fluid. We get different headlines on a, day-to-day basis. But, it is important to know that, in our investment meetings, we do discuss areas and stocks that we feel could be most impacted by potential tariffs. And we do know that the risk is greater in some of our holdings and in some of our different industry groups. I think about maybe, some of our consumer companies that manufacture goods in China or Vietnam that could be subject to large tariffs on imported goods. Or maybe it's a technology company that is manufacturing a microprocessing chip in Asia or some other piece of hardware. So it's very fluid and it's really difficult, but we know that there will be some impact, some negative impact. I think it is important to note that, when we buy stocks, we do try to invest in market leaders. And by investing in market leaders, we take comfort that, these are the kind of companies that are going to be able to manage through these changing environments, whether it's interest rates, whether it's tariffs. And in this particular case, we feel that, as a market leader, these companies will be in a position to price to get pricing power, whether that is increasing prices that we, the end consumer, pay, or maybe it's pushing back on the supply chain where ultimately the suppliers are going to be funding most of this increase coming from tariffs. So overall, yeah, we know there's going to be some impact. It is very fluid, but we do take a lot of comfort in the kind of companies that we own, feeling that they're very well positioned to kind of manage through this.
Great, thank you, Matt. I know James Lewis, who covers our consumer stocks, spoke to the holiday shopping season and saying a lot of the buying is done right now. And so having that uncertainty is a wild card, looking forward, 5-6 months from now. Great. Well, we'll get back on the investment side, but want to touch on Jason. There was a question on Social Security, viability, when to take it. Is there, any, change to our typical answer and how we handle Social Security with our clients?
Yeah, it's a good question. The viability of Social Security program has been an issue for a while, and the latest figures are pretty sobering. In fact, many of our younger clients, if they are looking at their Social Security statement that they get each year, they get that from online. You got to go back a couple pages, but they'll talk about a haircut on the future benefit for our younger clients. So it's a real issue. And I think in the past, our recommendation almost across the board for our clients was, wait until age 70 to take your Social Security, because between full retirement age and age 70, you get that 8% increase. And I still think that that's going to apply for a lot of our clients, but I think we've softened a bit on that language. So, maybe saying, hey, take it at full retirement age. I still think it's really important to run the numbers. There are break-even points, and obviously you want to consider health in the equation as well. So overall, our position has softened a bit in terms of waiting to the last moment because of the overall viability of Social Security.
Excellent. Yeah, that's a interesting update and nuance there. So there's a few questions on AI, and I'll kind of piece it together. Matt, this will mainly be you and me touching on this one. So part of it is the overall positioning, so we've talked about some of the current AI beneficiaries, but, what are some of the areas that we're looking at that are, the current and future beneficiaries? Because we've talked in past strategy updates about, the three phases. We've got the infrastructure phase, we've got the platform phase, and then eventually the productivity enhancement phase. And so some of the questions here are, around, Microsoft. So if they're laying off people, is that reduction in workforce, a primary benefit of AI? Another question is around, Accenture. And, despite them, being at the center of consulting on AI, why hasn't their stock, done as well recently? So maybe just, touch on a few of those topics.
Sure. Yeah, I can let me answer those two specific, Brian, and then we can kind of circle back a little bit. But as we think about Microsoft, the announced layoffs, is that a result of AI, and is that really the financial target of AI? I'd say this. I mean, part of that, is probably the result of some AI efficiencies they're going to get, and as I highlighted, Microsoft is deep into the weeds in AI. How it's benefiting financially, in many different aspects. But no, I think when you think about the long run, the greatest financial impact to Microsoft, and I think most of these companies, especially kind of these early plays, the infrastructure plays, are going to be the revenue streams. The headlines sound, large, the number of layoffs and what that cost saves in. But that's not in the billions of dollars that we're seeing with the new revenue streams that are going to come to Microsoft, that are coming now and will continue to come out going forward. So I think ultimately the end game and where we expect to see the most benefit to these companies will be on the revenue side. Certainly the cost saves, the operational efficiencies are going to be part of it as well. To answer the question on Accenture, this has been a tough one. Accenture, again, they're deep into the weeds as far as AI. I gave you some numbers about the rapid growth that they've seen over the last several years, and it's very similar. Actually, it's actually superior to the growth that they saw in cloud computing going back several years. So, it's very fast paced, but it hasn't yet translated into stock price performance. I think part of that is one, there's some skepticism. We want to see more. They're not in the infrastructure bill. They're not NVIDIA. They're not Microsoft. They are growing, but it's $1.5 billion versus multiple billions for some of these other companies. So we want to see more of it. But I think one of and maybe the biggest headwind is DOGE. Accenture has about 8% of revenues that are exposed to federal agencies, and there's obviously a lot of scrutiny. There's going to be a lot of cuts in contracts. And they're one of those companies where they could see, a revenue hit because of that. And I think the final reason is that we are back into a very growthy market. And when we look at especially technology sector, technology stocks, investors are paying up for the highest growth companies. And somebody like Accenture, who does have a very nice growth profile, but is a bit more defensive, unfortunately, is underperforming despite a fundamental story that remains very healthy. So that's kind of how I see it for Accenture.
Yep, that's fantastic. Thank you. And then one question on just the earnings surprise that we saw in the outperformance and expected earnings driving to new highs. When you think about the earnings reports that came through, what were like the main drivers of the outperformance there? Most of them came from your sectors, tech and communications, that were the surprises to everyone.
Yeah, I think if we go back, whatever to corporate earnings season, the most recent one, and we're now just kind of getting into another one here. But I think analysts, started to get really conservative in some of their numbers, fearing, what could happen with tariffs, inflation. Our business is going to continue to spend money. There were some rumblings, again from Microsoft, or they're cutting back on AI capex, all of that. And I think ultimately what happened is that the numbers came in better than street analysts were expected. I think companies always try to set the bar fairly low so they can outperform. I think we saw some of that. But I think at the end of the day, corporate spending was a little bit stronger than most expected, especially kind of in the IT space. Again, after a couple of years where spending had been very muted. So The fundamentals just across corporate earnings, just were better than expected. And I think we also saw companies really start to focus in on the cost side of the business, and whether they're getting some of that from AI or whether that's just more intentional, knowing that we're kind of entering this period of uncertainty created by this tariff risk, tightening of the belt a little bit. And, you get decent revenue growth, you get some margin expansion, and ultimately you get your earnings growing above some street expectations.
Wonderful. Thank you, man. Well, with that, we want to be mindful of everyone's time as we're at the 45-minute mark. So if we did not have an opportunity to answer your question, a member of your Bartlett advisor team will be sure to follow up. If you asked an anonymous question, please follow up with your Bartlett advisor. If it's truly anonymous, we can't see who asked that question. Just one housekeeping note there. So we hope you found this discussion useful in understanding the current state of the markets and Bartlett's thoughts as we look ahead. We're excited to offer these more frequent touch points and welcome all feedback, as we're always striving to be a more valuable partner in helping you reach your goals. So thank you again for being a valued Bartlett client and for joining us in our mid-year update, and hope you have a great day.